And once we pass 3,500, we should start seeing the next rally, which shouldn't take too long in time span. Should be about 1 or 2 months until we get to a new plateau. Could be 4,000, could be higher than that. It's hard to tell exactly where it'll stop. But in the meantime, we also have to look out for the end of the last tranche of 2020, 2021 money printed fuel. And because we have now still about $100 billion left in reverse repos, which is the backup, that's still going to run out. And when it does, the Fed is going to have to print again because all of the extra reserves are still being used in the plumbing of the system, and they can't be double booked. They can only go in one direction. And all of the hedge funds and everything like that uses that money, they need that to keep coming or they have to close their trades, and that could cause a systemic toppling. So before that runs out, we should see gold start to rally, and I'm not discounting that gold and silver will get hit, perhaps severely, though less severely than in the event of some kind of a clog in the plumbing. But that's only going to be like, a few days until the Fed responds, and then we should see a slingshot. So I'm not counting that as part of the trendy consolidation versus rally. That's something else. Like, for example, if you look at 2020, like February, March, April 2020 in gold, it was a humongous dip, and it was one of the worst dips in history for gold stocks. But if you look on a chart that's 5 years or longer, you don't even see it. It's not even there because it was so short. This one's going to be even shorter. It's going to be very scary, but it's going to be shorter. I don't know how big it's going to be. In terms of percentage, well, I think gold was like 25% from the top, maybe in February 2020 or early March 2020 to wherever it stopped at 1450. I think it was like maybe 1800 down to 1450. What percentage is that? It's something like 25% from, and I don't think I'm wildly off there. I'm just not doing the math in my head. So, we could see something like that. What's 25% of, let's say, 3,600 in gold to like maybe 2,800, 2,900 in real panic on a repo crunch? Yeah, it's possible. But most of my positions were established way before 2,800. So, unlike 2020, which really got me, my heart pumping in a bad way and, sweating, I held on. But this one, it would be like, a little bit, like a mild roller coaster, like something I could handle. And I'm sure most of your followers could handle it too if they got in before 2,800. So it'll be difficult, but it won't be a 25% dip from here wouldn't affect most of the stackers as, a 25% did from 1,800 to 1,450. So breadth are similar move percentage wise, but I don't think the stackers are going to be fooled like they were last time. And I queried some AI on this just to make sure I'm right. I don't use them for my primary research, but I check my conclusions with AI to see if there's something wrong with them. So this checked out. At least, so if you imagine what's happening in a margin trade, when let's say an institutional trader wants to increase his position for his clients, so he borrows on margin from the broker's got to get the dollars from somewhere. The broker gets it from the bank. The bank gets it from the repo market, at least, about half the time. Ultimately, you have this loan that's secured by equities by the client to the broker, right? The broker pledges his securities, which he still owns, but the broker maintains his right to sell those securities by force if the margin loan can't be paid in time. So that puts the client of the broker in danger of having his stocks force sold. And the broker itself has to pledge those securities to the bank, right? The same securities that the client pledged in, ultimately they're pledged to the bank. So the bank has to sell. It's really not up to the broker. The broker is just a middleman. The bank has to sell the securities so it doesn't get its dollars back. But where does the bank get its dollars? It gets its dollars from the repo market, for which the bank that's giving dollars ultimately lends the repo market every night. So these margin positions are ultimately dependent on the treasury securities that are pawned off to the repo market to another bank to secure the dollars that some other bank has in reserve. So since people are always asking for more and more margin, as we see, I think Andy Schefman talked about this on an interview recently. And I was talking about how margin loans have exceeded $1 trillion. There's no significance of $1 trillion other than that we're base 10 humans because we have 10 fingers and 10 toes. So 1 trillion is a psychological number for us. But the rate of increase in margin, the amount of margin debt outstanding that's ultimately secured by treasury securities, right? That the rate of that has been going up and up. The acceleration has been going higher and higher. And we've had 2 months of, I think, above 15% monthly acceleration, which you only had, I think, once in 2000 or 2 months consecutive 50% or higher, something like that. I know it's in the double digits, and it's among the highest months of acceleration in margin debt ever. So what happens is if the dollars run out in the repo market, right, and then the amount of interest that you have to pay, because it's supply and demand. If there's more demand for the dollars than there are dollars available, the interest on those dollars has to rise, right? In order to pay them, you have to, because he has no cash in his account, otherwise he would be trading on margin. He's already fully positioned. So he can't pay those suddenly spiking interest rates. And then they have the broker gets called in by the bank, like, you have to pay me that interest because we're having a repo clog here and the interest is going up on those daily, nightly repo loans. So you have to sell those positions and pay that interest. And then the bank said, but if everyone's doing that, everyone has to sell the positions, the value of the stocks that they bought on this margin loan are going to go down together because everyone has to sell or pay the interest rates. Right? And then if the value goes down enough, then if it goes down enough, then they can't pay back the margin loan itself, the principal. If the value of the stock's being pawned off for the margin rate for the margin loan in the first place can't be pawned off, and then the bank itself gets in trouble because the bank is the one that pawned off the treasuries in order to get the cash in the first place to give to the broker to give to the client. So if the bank's treasuries get forced sold, so the bank has to sell those securities plus some of its securities that they secured with the other bank to get the dollars, then you have a whole bunch of treasuries being forced sold at the market in order to pay back these margin loans. So what you have is eventually, if it's allowed to go on long enough, let's say a few days or a week or two, stock positions being forced sold to pay back repo margin loans. And if the value is not enough because everyone's selling, then a lot of treasuries get sold in order to cover the repo loans where the stock values can't plug in the hole. So you have rising interest rates, short-term interest rates on the repo market, plus rising long-term interest rates if treasuries are being repossessed in order to pay back these repo loans, and everything's falling at the same time, which would include gold and silver and everything except the US dollar itself very temporarily until the Fed steps in, which is what it's going to have to do. It could go either way. I don't know how it's going to play out, but I do have a strong feeling this is going to be the last time. As you go down the fiat process, crashes get closer and tend to get more intense. But the intensity also, on the one side, yes, they do get more intense. On the other side, the Fed becomes more aware that it's going to have to act sooner and sooner following any kind of sign of stress, which is what we saw in 2019 and in 2020. And I think we're going to see it again. So we're going to see some kind of intense move, but we're also going to see the Fed act very quickly, where in 2008, it took them, maybe, a few months. It depends where you count where the stress started. You could count it years, starting with the top in the real estate market in 2006. You could start it with the excess reserves or whatever they were doing in the banking system in 2007, where they allowed the Fed to pay interest on excess reserves. Most people don't know that entire process, that entire set of rules was only instituted once the banks told Congress, look, we need the Fed to be able to pay interest on excess reserves to keep all these reserves out of the monetary system because otherwise everything's going to explode. That actually happened before the financial crisis even happened. So you count it in many different ways, but however you count it, it took the Fed some appreciable amount of time to really get moving. Right? In 2019, it was much less. It was like they saw repo going up and up for maybe a week or two before they moved. Whoever was in charge of locking down the planet said, look, we're going to do this. And the Fed says, okay, we'll print $4 trillion like in the next day, or 2, 3, 4 days, whatever it was. So it's going to be very quick, but it's going to be very extreme. In terms of will it be felt in the stock market, I don't think for beyond a day or two in terms of nominal values, but once the printing starts this time, I think we're going to see gold and silver, especially silver, really start to move like in ways that are going to be scary even for stackers. Because if you put yourself in our situation, in order for silver to, let's say, move like 20-30% a day, prices, oil is going to start heading up. Commodities are going to start heading up, not as fast as gold and silver, but they're going to start heading up very scary. And we're going to feel like, happy, but, worried at the same time. That's when we know that we're really close. When our happiness is tempered by our own fear, even if we're in a good situation financially, which is, once you start feeling that, you'll know we're almost there. And I think that's going to start to be felt once the next printing round begins, whenever the last bits of monetary stimulus for 2020 finally run out. Should be in a few weeks now. I'm in the US now, and I'm seeing really concentrated trends in certain industries that are kind of scary. I mean, if you think about them, like every billboard that I see is, some kind of, not every single one, but like, so let's say, 50-60% of all billboards as I drive on the highways, they're about, there's this big amount of money, let's say $500,000, and some injury attorney, he's talking about how he can sue for you. I hear these ads on the radio nonstop about the same thing. Everything's concentrated now. All the money's concentrated in insurance claims and accidents and injury claims and whatever. This is where all the big inflation is going, or part of it. So when you have a society that's so concentrated in these very specific areas that are not very productive, all of that money goes away, and you have all these people in these very inflated industries that are suddenly unemployed and they have nowhere to go because there's no demand for their services anymore. So the people that are in the very concentrated inflation influenced areas like litigation, that's one of the reasons we have such a litigious society, and securitization. Right, I'm reading a book now about how the CMBS market, the commercial mortgage-backed securities market, is structured, and how much employment that feeds. So you have basically any profession that's involved in moving paper around to configure a refinancing of something to keep a pyramid going, basically somewhere in the structure, they're going to have to find something else to do, and most of them don't have any practical skill. Manipulate the system in some way that right now is profitable. So those professional classes are going to get really hit. People with skills they're also going to get hit if they have minimum wage jobs now just to keep going. But if they have skills, their skills will be in demand from somewhere. I don't know what their standard of living is going to be, but they'll probably be in better situation than people who have no skills other than pushing around big piles of mortgages to try to get him more time to pay his loan. Bankers, that sort of thing. So these people are going to be and people that are living hand to mouth now, if they have skills, they'll probably, move up a little bit, because the inflation is killing them. And once the hyperinflation comes, the inflation is over and they can start rebuilding. So yeah, there's going to be a period of difficulty for them, but it's going to be easier for them than, let's say, a hotshot banker that has no skill in how to do anything. And not just, what is the society and the collection of its people? And society doesn't know how to what is moving it. And you look around at this humongous system, it's like, how does this all work? And I can't answer that either. I have no idea. Other than I'm just focusing on teaching my children how to work with their hands, how to sew, they know how to crochet, to create things, just to give them confidence in using their hands. My daughter might be the only one in her class. She's in second grade, the only one who knows how to tie her shoe. Shoes her size, the shoelaces on them. We couldn't find it because nobody knows how to tie shoes anymore. And I have nieces and nephews that are older than her, like maybe 10, 11 years old, that told me they don't know how to tie shoes because they never had to do it. Right. And I'll tell you this, like my wife teaches gymnastics, or tries to, but she just realized after a year or two of trying to do this, that children actually lack in this generation, in Israel I'm talking about, I don't know what it's like in the US, maybe you've seen this too, they lack the ability to even understand that following directions is a thing that you have to do, because if there are no consequences to actions, right? If you don't have that, you don't have the ability, even if you wanted to basically follow directions and do what an authority figure is telling you to do. And I'm not saying all children have to listen to authority at all times. Obviously not, if they're saying or doing the wrong thing. But the basic skill of being able to follow directions is now, the fact that we're naming it executive function means that it's not taken for granted that you even know how to do these things. So now my wife is trying to figure out, how do you teach kids the ability to even follow directions? Like, if she's saying something, therefore you follow, but even that logical connection is not there. How do you do that without the ability to impose consequences on the kids in your group? Like, okay, you didn't come with a leotard, so you can't participate today. She can't do that because she'll get fired. It's impossible. And you don't have any skills, or kids can't do anything. It's like kids don't even have, beyond that, the ability to understand that following directions is a thing. Yeah, well, you could just take the most basic example of bailouts. Everything the Fed does is by definition a bailout, because they create claims on gold that doesn't exist and give it to people so that they can spend. Whatever the Fed does is a bailout. It just comes in bigger or smaller chunks. So basically, a bank can do whatever it wants, and it might experience some minor consequence somewhere. You have a headline, Wells Fargo paid $2 billion in fines for spoofing or whatever it is, and then the article goes into what spoofing is and why it's immoral. But then again, they're like, the entire banking system is being bailed out every day by the Fed providing whatever it is in the back end. It's just that we see it more in chunks when it happens in a bigger way, like we saw in 2008, like we saw in 2019, like we saw in 2020. Without consequence. Not without consequence. There will be consequences, but you can delay them with inflation, or you can spread them out over a longer period of time with inflation, so they're less noticeable. Right? If there was no Fed and there were lockdowns, people would starve within days, and that didn't happen because of the money that was printed that could just flow through the system and keep it sort of kind of working, so that nobody starved to death. But yeah, so if we're going to take the example of executive function with children, the bankers today, they're proud of how they are handling the current pyramidal structure, which, if you listen to the details of it and listen to them explain, some of them are very smart people, and most of them they're not nefarious people individually. They're not trying to hurt anybody. They're just doing what they see as the system, and they're trying to keep it in balance. So that's what they're supposed to do, but they don't know that it's wrong. Just like kids don't have an executive function because they were never taught what following directions is. Bankers don't know what they're doing because they've never been taught what money is. It's the same thing. It's just one is the entire society, the entire economic structure, and the other is one child who was never taught by his parents.